Hi, it's Grant Miller from Inspired Financial Planners here. Today I'm going to talk about a really important subject. It's about income protection. Now don't tune out just yet. This is something super important because there are some major changes coming at the end of this month and I don't want you to miss out. I don't want you to be left destitute under the new policies that are going to be offered. I want to make sure that you're looked after. Now, for those of you who don't know me, I'm a financial advisor primarily for healthcare professionals, but I do have a number of clients outside of that space. I primarily work with allied health and nursing professionals. Now, what I'm talking about are the changes that are going to come from the end of this month. So first things first, we've got to talk about what is income protection. Basically, it is an insurance product that covers a good chunk of your income if you're unable to work due to illness or injury. That's the general premise behind it. Now, I'll give you a couple of examples where that might come into play. I've got a client who is in his mid-30s. A couple of years ago had a claim due to an aortic aneurysm. Unfortunately, he's still unable to work, so his income protection policy has been paid ongoing and will continue through to the age of 65 if necessary. They had just bought a house, is married, 2 kids, and this literally came out of nowhere. It was otherwise healthy, no prior medical conditions whatsoever. And this has literally saved them from having to sell their house and take whatever other kind of drastic measures. Another example I have is a friend of mine whom I'd reached out to about a year and a half ago. He had been in his profession for less than 3 years, and there are some special offers for new professionals. And so I said, mate, before your 3 years is up, we need to get your policy all set up. And unfortunately, they never acted on that and never got anything set up. A few months ago, he was at the park with his kids, jumped off the swing, landed wrong, and suffered a spinal injury, and is still in hospital recovering at the moment. Unfortunately, had no income protection at all. Very fortunately, was wise with his money in other ways and had some savings. And so that's helped them to get by. NDIS is only just kicking in. And unfortunately, the fact that he was working in quite a well-paid profession before, not too sure if there's the ability to return to that in the future. So major changes to their circumstances that could have potentially been mitigated through getting an insurance policy set up. All right, so what I want to talk about is what the major changes will be. This is how they'll assess your income, how much they will pay when you're on claim, and how they'll assess your ability to work on an ongoing basis during claim. All right, so at the moment, the way they assess your income is they're going to look at the best 12 months out of the prior 3 years before your claim, which is before the incident that caused you to go on claim. Could be that you got hurt, could be that you are now sick enough to be off work, and that's the date you saw the doctor. That's the date of your claim. That's when it starts. The way that they're going to assess it in the future with these new policies is they're going to look at the immediate 12 months prior to that event. So if you've had time off work, if you have had a drop of income during that period of time, it's unfortunate, but they're going to pay the lesser amount. They're not going to be able to look at, let's say, last financial year or the year before and say, yeah, you were earning better that financial year. We'll pay based on that because we're assessing your best 12 months. That stuff's out the window as of next month. The way that they'll assess how much to pay you. So when you set up your income protection policy, you'll designate how much of your income you're replacing, up to 75% of it. Now, if you've had your policy for a while, or you've had a drop in income, due to various circumstances, your benefit amount may be higher than 75%. But basically, that's the portion that they're going to protect. And that's all based on the income you generate through work. It's not based on any income generated through investments or anything. However, the new payment assessment may include income from business, even if you're not working in it. It may also include income from investments, in addition to the income that you generate personally, which means that the amount that they will pay could be drastically less because you have other income sources. Now, in the best case scenario, they're going to replace up to 90%. I have seen an insurer say 75% is what they're going to go for. Unfortunately, there's still a lot of uncertainties. Even though it's 3 weeks away, insurers still haven't released the products, so we don't know exactly what they're going to look like. And then after 6 months, best case scenario, they'll replace 70%. One that I've seen will only do 60% ongoing as well. So just keep in mind that the amount that you will receive ongoing could be drastically less as well. All right, now the way that they currently assess the way you're disabled, which is, are you eligible for an income protection claim? So have you suffered a loss in income or a capacity to generate an income due to illness or injury? That's basically the major thing that they're going to be looking at. If you can't do the occupation you were doing when you made the claim, that's what they're going to assess for the duration of the claim. Okay? With the new policies, they're going to assess after 2 years of claim, can you do any occupation that you're reasonably suited to by way of training, education, or experience. They're going to widen the gap to say, all right, you couldn't do that, but what else could you do? And they're going to assess it a lot more aggressively, which could reduce the amount that they pay you, or it could end the claim completely. Now, keep in mind with this having suffered a loss of income, I do have a client who's been on an income protection claim for over 10 years. She's currently working part-time, and there's a gap between her insured income and the amount she's currently earning. Income protection is kicking in and filling that gap. However, if she's not able to work whatsoever, she gets her full benefit, and if her income increases, that gap is basically going to reduce because her income is actually higher and the need for the insured income is going to be much lower. Okay, now why is this relevant? Income is your greatest asset. It's the thing that gives you all the money that you need to keep spending on things. It's the thing that you need to be able to start investing and growing your wealth. Super, super important. I'll run you through an example of a hypothetical where you just earn 80,000. We're assuming no pay rises whatsoever. It's consistent throughout the rest of your working life. If you were off for 3 months, you're going to be looking at $20,000 worth of income lost. If it's 3 years, it's 240,000, or 30 years is 2.4 million. Now, I would suspect over 30 years, your income from your work should be increasing. It shouldn't be staying stagnant at that same rate. So your actual lost income could be drastically higher. A decent income protection policy will have an indexation, which basically means as the cost of living increases each year, your benefit amount should increase each year while you're on claim as well. And that's just something to be very mindful of when it comes to your income protection. So, if you're relying on the cover through your super, it is very, 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 very likely that this is going to affect you quite quickly. There may be a bit of lag time. We don't know how they are going to respond, but all insurers, all super funds insure all their members as a group, and they typically will outsource that to another insurer. And so you as an individual, even if you've tailored your cover through your super fund, the terms of your cover can, will, and do change. Now, that's because, as I said, the super fund insures the group, not you directly. A personally underwritten policy through a financial advisor will have a relationship between you and the insurer. It's not the group. Therefore, as long as you pay your premiums, they are contractually obligated to keep your benefits at least the same, or they will upgrade it as long as that upgrade in benefits doesn't cost you anything more. Very big difference between what you would get through your super fund versus getting a personally underwritten policy. All right. Now, you might be thinking, if I go through a financial advisor, I'm not going to be able to pay any of my premiums through my super. That is a lie. There may be very, very, very limited circumstances where this isn't an option, but for almost everyone, you can still pay your premiums through your super fund. That's because the insurer has their own super fund, and they basically say, hey, premiums are due, request a transfer of funds, and away you go. You don't have to change your super fund at all. You can keep the same super fund and still pay for your income protection and other insurances through the insurer's super fund. Okay, if you do decide to pay your income protection policy personally, up to 100% of those premiums are going to be tax deductible as well. So if you're on a 34.5% tax rate, which means you're earning between $45,000 and $120,000, then over a third of your deductible premiums can be paid back when you lodge a tax return. So let's say you've got $1,000 of deductible premiums, right? That means you're getting over a third of that back when you lodge a tax return. Pretty good way to reduce your taxable income and to reduce the total cost of your insurance as well. It also means that we're overcoming any issues with having insurance through super, because you've got to remember, insurance through super is still governed by the rules to access your super prior to retirement. So there are still a lot of restrictions with accessing your benefits through super. Generally, the way I set it up where cash flows are concerned, so I'll have the bulk of it through your super fund, and then any of the extra benefits that can't be held through super that are still really valuable, you just pay the difference personally. A lot of that's still tax deductible, but it's really valuable. It means you get all the best benefits out of your policy. So what to do? We're all really familiar with QR codes now, so feel free to jump on here, pause it, go to the website, book in to have a chat, or send me a message, flick me an email, whatever it is, whatever's most comfortable to you, or just go straight to the website inspiredfp.com.au, and let's have a chat about what you currently have, what your options are, and what the process is going to look like. I do need to stress the importance of getting this done ASAP, because the time it takes to research policies isn't just like an overnight thing. It can take time to get this done right, so you need to act quickly in order to make sure you're getting the best benefits now. Once you're on the website, jump over and hit the get in touch if you just go straight to the website, and that'll take you to the contact page. Feel free to pause it here as well, not only to scan the QR code, but to have a read through the disclaimer. Basically, anything in this video is information only. It hasn't been tailored to your circumstances. You should receive financial advice before acting on anything in this video. All right, hopefully that was helpful. If you do have any questions or need a hand with anything, feel free to reach out, leave a comment, send me a message, whatever works, and I'll be super glad to help. All the best. Bye.